Welcome, everyone. This is Dennis Stearns on behalf of our all-star panel today from Stearns Financial. We have Tara, Teresa, Paula, and Courtney, who are going to help us all understand more about the massive CARES Act, the new Rescue Act that was passed by the federal government. I think probably everybody knows that normally we wait until we get more guidance on different parts of the act from Internal Revenue or other places. What we have found is that some of the information is actually changing daily from the original act. So there will, I'm sure, be a number of other changes as we go along, but we're going to hit some of the broad categories. So let's start with just the big overview of this historic package for rescuing the economy. Bill, next slide. So this $2 trillion act, as we have mentioned in other places, as a percent of the economy is large and historic, approaching 10% of the value of the economy. So it's not just the dollar amount, it's the putting it in relative terms to the economy. It's pretty darn big. And if you took the different programs, there was a rescue program back in 2008 and then a couple of stimulus programs. If you put all of those together, they would about equal what has been done on the front end of the coronavirus crisis. So the areas that we're going to be talking about, you can see on the screen a big chunk of money of the $2 trillion going to individuals, and then large corporations and small businesses get a pretty big chunk. State and local governments, some pretty important things there. And we're going to have more texture on all of this, including the public service piece at the bottom in our regular chat. Because of the complexity of this, we're not sure the regular chat it will be out today. It probably will be out over the weekend. That will give you more texture on all of this. So with that as a backdrop, let's get started. And we'd like to start with Courtney. What do we need to know about the recovery rebates?
Thanks, Dennis. From the graph that you just showed us, the top 30% of the act covers the cash that's coming to individuals. So the biggest part of that we've heard about is the free money that we're going to see in our checking accounts. And this is probably as close as we can get to free money from the government. If you are in a qualifying household, which would be $75,000 or less in income, then you'll get a $1,200 check for each adult. So $75,000 as a single or head of household taxpayer, $2,400 if you are a married couple and have an income of $150,000 or less. If you have children, you get $500 per child up to a certain level. You can get some of this money if you make more than $75,000. Between $75,000 and $99,000 as a single or head of household, the amount phases out. So consider your taxes this year. The way that they are determining who gets what amount will be from your most recent tax return. So if you filed 2019, they will look at your AGI and use that number to determine if you're eligible. If you have not already filed your 2019 return, they will look back to 2018. So here's a planning opportunity if you have not already filed. Take a look at your AGI for both years and determine if either one of those amounts would apply and make you eligible for the payment. Some people have been married or a divorce. Maybe you've lost your job or gotten a promotion and you have drastically different incomes for the 2 years. It could affect whether you get the payout or not. The good news is if 2018 and 2019 are not qualifying for you, in 2020, if you have qualified this year, you can get a tax credit on your 2020 return. So something to look at as we move forward with this.
Yeah, thanks, Courtney. And just as a reminder, Courtney, for all of our listeners, what does AGI stand for?
That's your adjusted gross income. So that will be line 7 or 8, depending on which year you're looking at on your return.
Okay, thank you much. So now we're going to turn to retirement plans. Tara, what should we know about retirement plans under the CARES Act?
Great question, Dennis. First, I want to hit on the broadest categories of changes, and this applies to everyone, whether you've been financially impacted by coronavirus or not. The first is that we no longer have a 2020 required minimum distribution requirement. So for clients who would have a required minimum distribution this year, they can choose whether they want to take money out of their retirement account or not, because they're not mandated to do so. And as we think about that, we want to consider who should maybe still consider taking withdrawals from retirement accounts. And I want to hit on a couple examples of clients who may still want to take a withdrawal even though they're no longer required to. The first would be someone who needs withdrawals from a portfolio to cover their living expenses. We still might want to use the retirement account to make sure we're keeping a good balance between retirement and non-retirement accounts. Another example would be someone who potentially doesn't need it to cover expenses, but may have a lower tax year in 2020. And so they want to take advantage of being able to pull the money out under that lower tax bracket. And there they have a decision to make whether they would want to do a Roth conversion or whether they would want to invest that in a non-retirement account. A third example of when someone potentially would still want to take money from their retirement account is if you have charitable intent and you've been using the QCD or Qualified Charitable Distribution Strategy, where you can take money directly from your retirement account and give that to a qualified charity. And by doing it that way, you avoid the income coming out of the retirement account being taxed. So those are some examples of when you still want to take a withdrawal. Now keep in mind, even if those do apply to you, you don't have a required amount, and so you can find the beneficial amount for you. But I do want to hit on one example where you might not want to take the required minimum distribution. This could be for someone who has named a charitable organization as their beneficiary. So we want to keep those withdrawals to a minimum, because when they pass that asset on, it's not going to be taxed at all. And some of our clients have decided to go ahead and avoid these required minimum distributions, to go ahead and let the account recover as the market recovers in the coming days. The second retirement account rule that applies to everyone would be for those who inherited an account between 2015 and 2019, and they elected the 5-year distribution. And for those clients, 2020 no longer counts as a year, and so they have 6 years to make those distributions. Finally, I want to cover 2 items that do only apply to those who've been impacted by the coronavirus. And we can first define what that means. That one means that you have been diagnosed with it, your spouse or a dependent has been diagnosed with it, you have reduced income because of your employment situation. So those are examples of when these 2 options would be made available to you. The first is that now you can take $100,000 from a retirement account. That could be an employer plan or a traditional IRA. And you do not have to pay any penalty on that, even if you're under 59 and a half. And in addition, you have 2 options for the taxation. The first would be that you pay the taxes over the next 3 years. Or the second would be sometime during the next 3 years, you return the money into the retirement plan and avoid the tax altogether. The second option that's available to those who've been impacted by the coronavirus are that they have increased abilities to take more money out of their employer-sponsored plans. Those limits have been increased now to the lesser of either $100,000 or 100% of the account balance.
Very good. Thank you, Tara, for that overview. And so there's quite a bit of texture there. And I think that in the coming weeks and months, we are going to be working with a lot of our clients and their accountants to try to sort through what the choices are. So let's now go to the area of the CARES Act on charitable donations. And that is a kind of an interesting one because we have a few clients who have decided they are really going to lean in. They have lower living expenses, canceling travel and things, and they're going to lean in with charitable entities they work with to help those affected by the coronavirus. So this is another interesting area. Paula, will you lead us through that?
Sure, Dennis. There are a couple of notable items for clients who are charitably inclined. As we all know, recent years tax legislation has favored the standard deduction over itemizing, mainly because of increase in standard deduction. So there's a little bonus in there for people who are taking the standard deduction. With this package, they can deduct up to $300 cash. But again, that's only cash. That doesn't relate to investments donated or real estate, art, or other items. And of course, as always, it has to be made to a qualified charitable organization. A lot of people would feel like maybe this is not much, but it helps and it adds up for these charities. So might want to spread the word for those who take standard deductions. And for our clients that itemize, if you're making a cash deduction, if you're making a cash contribution, that will now be deductible up to 100% of adjusted gross income. Recent tax legislation made that deductible up to 60%, so this is an increase in the amount that can be deducted for those who itemize. But it's important to note that that does not apply to donor advised funds, which are very popular among our clients. It also doesn't apply to contributions made to private foundations or organizations that don't typically apply for that 60% of adjusted gross income rule. And there are no other percentage limits that have been adjusted on other donations for, again, real estate, art, or other investments. Those remain unchanged, those percentage limits. So those are really the two primary changes in the package related to, or that those who are charitably inclined would want to know about, Dennis.
Very good. Thank you, Paula. Next, we're going to turn to one of the real hot topics, unemployment. And for those who have been paying attention, the unemployment figures have been skyrocketing. Those who are applying for unemployment insurance. And unfortunately, around the country, many of the state-run and county-run programs are using antiquated technology that probably isn't up to the task of all the volume going on. So we're hearing stories where it's working okay in some places and not so okay in other places. So Teresa, can you walk us through what we need to know about the CARES Act on unemployment?
Yes, thank you. That's a great point. We're going to talk about that in a little bit about applying. As everyone knows, the uptick in unemployment was huge last week. I believe about 3.3 million people actually applied for it. So we can see that there's been a dramatic effect on employers trying to retain their employees. And so the CARES Act has come in and tried to relieve some of the burden of income issues with individuals and families. So keep in mind that what we're going to refer to and talk about here under this topic only applies to those who have lost their jobs due to the coronavirus. So the first major change is that the benefit amount has increased. Typically, your benefit is calculated based on a state calculation, but they've now included or added a $600 flat federal amount that is now added to your state calculation. So in North Carolina, the maximum benefit you can receive is about $350 per week. And then if you add the federal $600 flat amount on top of that, in theory, you could receive a benefit of up to $950 per week. Keep in mind that these benefits are taxable income to you. The second big change is that they've extended the benefit horizon for how long you can receive these benefits. So in the past, there was a maximum 26 weeks in which you could receive the benefit, but that has been extended to 39 weeks. So they've added 13 weeks to receive the benefit. And keep in mind that even if you've already begun receiving the benefit, you know, maybe a month or two ago, or if you've already maxed out your credits, you are still eligible for that 13-week extension. And the last major change is that they've broadened the definition of who's eligible. So typically people who have lost their jobs due to no fault of their own, which includes furloughed workers, are generally the people who are eligible, but they've expanded that definition to include people who are seeking part-time employment, and also those who are independent contractors or self-employed persons, such as freelancers, gig workers, such as an Uber driver. So that is a broader term and can help more people under the new CARES Act. So, you know, how do you apply? Probably the best way to apply is to go to the website. In North Carolina, if you're in North Carolina, the website is des.nc.gov. And as you can imagine, they're overrun with requests and claims and people trying to submit their applications. So a planning tip would be just to either try maybe really early in the morning or wait until, you know, late at night, or if you're a night owl in the middle of the night, you may have better luck submitting your application at those times. And the last thing I just want to mention is that even though it may take a few weeks because they are backlogged, it may take a few weeks to start receiving those checks, they are paid retroactively. So keep that in mind. And I think that covers the majority of the changes to unemployment.
Very good. Thank you, Teresa. Next, we're going to go to Courtney again for changes in mortgage payments.
Yes, the potential for changes in mortgage payments is probably more accurate. If you have a federally owned or backed loan, which would mean Freddie Mac, Sallie Mae, Fannie Mae, something like that, which over half of these mortgages in the United States are owned or backed by these entities, you're eligible for mortgage forbearance, and there's a moratorium to suspend or stop any foreclosures that are happening right now. The forbearance allows the financial institution to either completely suspend any payments that you're making on your mortgage now, or to modify it, maybe make it a lower amount, maybe make it interest only. There's different options that different service providers will use. So the first step you need to do to find out if you're eligible, you first have to have been affected financially by the COVID-19, and you will have to attest to that. If you are eligible, then your different providers can give you what their particular options are. Some of these will require that, say you miss 6 months of payments, at the end of 6 months, you owe all of those payments. Some of the options allow you to just extend the life of your loan. So make sure when you're going through to make any adjustments, you find out and get in writing what the policy is for your service provider. The moratorium to suspend or stop foreclosures allows the courts to stop any actions that are happening right now for someone. So if you are not able to pay your mortgage payments, I believe it's 60 days for federal right now, then you will not be evicted. North Carolina State has an executive order that has very similar parts as the federal it does. Their forbearance is for up to 180 days and can be extended for another 180 days. On top of this, there's no extra fees that the institutions can charge you. They can't give you a negative credit report because you are not paying your mortgage. So something to look at. If you do not have a mortgage that's federally backed, then a lot of the private or non-federally owned or backed are giving you some of the same advantages, but you just have to check with your provider. So first thing you need to do is contact your service provider.
Yep. Thank you, Courtney. And again, I think you pointed out well that there are federal rules in place, but there are state rules in place, and that is actually happening up and down the food chain, not only of the CARES Act, but a whole bunch of the other things that are coming out, which makes it a little bit more challenging and confusing at times.
Yeah,
All right.
indeed.
So, yeah, exactly. So next we're going to go to the area of student loan payments. Teresa, walk us through that.
Sure. So I think the biggest change to student loans really is that they have suspended all payments to federally funded student loans. So a federally funded loan would be something like most of the FFEL loans, the Federal Family Education Loans, and all of the direct loans. So those payments are now suspended through September 30th. While they're suspended, interest is not accruing. An important note is that you actually don't have to be impacted by the coronavirus in order to take advantage of this benefit. So if you have not lost your job and your cash flow is not negatively or your cash flow is not negatively impacted, then you may want to continue making payments during this time because any payments are going 100% toward the principal balance. So it's an easier way for you to whittle away at the principal a little bit faster. However, the one time that we would not recommend making payments is if you're in a loan forgiveness program. If you're in one of those programs, this suspended time still counts toward your loan forgiveness term. So even though you're not making payments, you're working toward that term. So it doesn't make a lot of sense to make those payments during this time. It is a good idea to confirm with your lender that your payments have actually been suspended. So contact your lender. And there are some other benefits related to this topic that we will be discussing in the weekend chat coming out in the next day or so. So stay tuned.
Thank you, Teresa. We are now going to go to one of the interesting pieces of the rescue, since we have so many small business owners as clients, and that's the small business area. Tara, walk us through that.
Thanks, Dennis. First, I want to remind you that, as Dennis mentioned in his introduction, that we are still seeing changes to the information that's out there. And one example of that relates to the business relief. And just yesterday, we saw the interest rate on the paycheck loan actually increase from 0.5% to 1%. So if this does apply to you as a small business owner, you do want to keep in mind that these regulations are still being finalized, and you want to stay on top of the changes that are occurring. But first, I want to hit on two options, and you can only benefit from one of these options. So the first is what we're hearing a lot about, and it's the Paycheck Protection Loan. And the reason we're hearing a lot about this is due to the forgiveness that's available. So what the Paycheck Protection Loan is that you're able, as a small business owner, and that's defined as a business with less than 500 employees in this case, you're able to apply for a loan that's 2.5 times your average monthly payroll expenses. And there's several things included in payroll expenses, so you'll want to dig into that. And then once you apply, if you do receive funding from this, the funding that you spend during the first 8 weeks after receiving the loan is what can potentially be forgiven. And in order to qualify for that money to be forgiven, 75% of it has to be spent on payroll expenses, and the other 25% can be spent on things like rent or a mortgage or your utilities. In addition, to qualify, you have to maintain a steady head count, and you have to make sure that you are not reducing your employees' pay. Now, the nice thing about the forgiveness is that if you were to qualify and receive the funds and you spend it on the correct items so that you could get forgiveness, but for some reason you're not able to keep that steady head count, or maybe you have to reduce salaries a little bit, the forgiveness still may be partially available to you. It's not a 100% forgiveness or a nothing benefit. It is pro rata. The other nice benefit about the forgiveness is the forgiveness amount will not end up as taxable income, whereas traditionally loans that are forgiven end up as taxable income to the business. The second option that you have available for you is the payroll tax credit. Now here they break the group into two groups. One is the smaller employees, and that's defined as less than 100 employees, or larger employers that have 100 or more employees. The difference here is both are eligible for the 50% tax credit, so that's up to $5,000 benefit per employee, but the larger employers have to prove that they were financially impacted by the coronavirus, where the smaller employees do not have that criteria. Those are the two big business relief things that we're seeing in the news, but there are some additional benefits that are available, and those include the 2020 payroll taxes. You can now pay those in tax year 2021 and 2022, so it lets you cover those expenses a little bit later. In addition, they have increased the ability for how much you can deduct of business interest, and that applies to tax years 2019 and 2020. The final thing we're going to hit on applies to tax years 2018, 2019, and 2020, and it's net operating losses. And now you're able to actually claim those 5 years backwards, in addition to carrying them forward forever. So there's a lot of things out there to help businesses, but I would encourage you, if this does apply to you, to make sure you're working with your banker and your accountant or CPA.
Good, thank you, Tara. And so in addition to clients who are impacted directly by this and are small businesses, which, by the way, we've had a number of conversations this week with those clients and their accountants, and occasionally their business attorney. And in some cases, it's turned out that the payroll protection loan isn't the best way for them to go. And there are other options, either through the SBA or through their regular banker. And so again, I think this is one of those that's case by case. But the overall overarching thing that we have seen from the CARES Act is the significant amount of help that it gives individual consumers, which will cushion the significant impact of the next couple of months of the economy, parts of the economy being effectively shut down, and then helping businesses not completely disappear. Now, there will be a lot of businesses that will not make it through this next 2 to 3 month period of time, but the Paycheck Protection Program that Tara talked about, some of the other provisions will help a lot of businesses make sure that they get through to the other side of this valley. And that's pretty important. Now we go back to the lessons learned from 08-09. This is a different kind of situation. This is an event-driven recession, not a structural recession. So that's an important distinction. But in 08-09, we had a rescue package, which was much smaller, 800 billion, compared to this 2 trillion. But then we had several stimulus packages, and it remains to be seen how many and how big the stimulus packages will be in the coming months coming out of this event-driven recession. So with that, I will just mention that from a frequently asked questions viewpoint, we do try to keep these Friday chats to 30 minutes. We do have a number of questions we are going to tackle in the regular poolside chat coming out this weekend. They range from things like the effect on our deficit short term and longer term. And there is a significant impact on our deficit. Right now, of course, it's a difficult choice because we have public health concerns that this act helps. We didn't really cover them as much in this particular chat, but the poolside chat will talk about the significant help that hospital systems will get around the country as a result of CARES. And then we also have just trying to prevent this from becoming a very long, very deep recession or worse. And so this act, the CARES Act, has taken a lot of those worst case scenarios off the table, or at least mitigated the risk significantly on the downside. So you should view this as opening act for everything. There are other frequently asked questions around what are the unintended consequences downstream from this, not just the CARES Act, but the coronavirus in general. We are talking to economists and other research sources virtually daily on some of the possibilities for what the end game will look like. And as we get better clarity on a lot of that, we will be reporting that out as well. So let me wrap this up by thanking Courtney, Paula, Tara, and Teresa, our panelists today, who have tackled this daunting subject. And also, I would like to mention that this has been recorded, as all our chats are being recorded. And so Monday, we will be getting out the recording of this chat as well as the 4 p.m. chat. Now, if you want to tune in live today at 4 p.m., that was on the same invitation you got for this particular chat. That is our special guest who wrote the book, Plato's Lemonade Stand. Outstanding material that you'll hear in this particular chat. And so what do? We all heard the adage, how do we make lemonade out of lemons? Well, what happens when it's raining lemons? And so this is a very timely topic. And I particularly love the distinction that our special guest this afternoon will make between how do you adapt to a difficult situation versus how do you actually lean in, innovate, and make something really better come out of a situation. Very timely advice. Again, thank you all in this one-size-fits-all crisis. We are here to help you think through your own individual situations. And again, on behalf of our panelists and all our SFG team members, thank you, and we look forward to helping you in the future.